Welcome to the deep dive. Today, we're plunging into the strategic world of finance.
hmm
Think of it as skillfully managing and using money to hit your goals, whether that's personal stuff, business growth, or even, how a whole country runs.
Right.
You're here to get informed quickly, but also thoroughly, so we've really boiled down the essentials from our sources, giving you a direct path to what really matters.
Exactly. And finance is, well, it's much more than just buying and selling things. It's a really broad field.
Yeah.
It covers banking, credit, investments, assets, liabilities. And then there's this constant flow of activities like loans, saving up, investing that money, getting funding.
It can sound like a lot, I imagine.
It can, absolutely.
Yeah.
But our goal today is really to pull out the most crucial bits for you. Sort of a shortcut to being well-informed, maybe with a few surprises along the way.
Good.
This whole deep dive is tailored to give you a solid grasp of the core of finance.
Precisely. So our mission today, unpack the basic ideas of finance, look at its different branches, and really get why it's so vital in the bigger economic picture.
Sounds good.
Okay, let's start maybe at the beginning, looking at finance's roots and its close ties with economics.
Yeah, that's a great place to start. What's really fascinating is the historical link, and actually how finance and economics are becoming more and more intertwined.
How so?
Fundamentally, both fields are looking at how people and organizations handle the trade-offs between, potential rewards and the risks that come with them.
Okay.
Every financial decision, really, whether it's you buying one share of stock or a huge company investing in a new factory, it involves weighing that risk against the possible return.
Right, the risk return thing.
Exactly. Economists, financial experts, they're all trying to understand and monitor those choices. And this blurring is important for you because it means understanding big economic trends like inflation or interest rate hikes is now directly relevant to, say, your personal investment choices.
Right. I always thought the traditional view was like economics is the theory, the big picture models, and finance is more the boots on the ground application. Is that changing?
That's exactly the old view, and yeah, that distinction is definitely getting fuzzier. It's not as clear-cut anymore.
Okay.
We're seeing a real synergy, you could say. Economic theories give us the frameworks to understand why people make certain financial choices. And then what actually happens in the financial world often pushes economists to develop new theories or refine old ones. It really works both ways.
So it feeds back into itself.
It does. And this leads us to something called financial economics. It sits right where theory meets application. It uses economic principles to figure out how resources get allocated specifically within financial markets. Understanding that is pretty key to grasping how the whole financial world spins.
Okay, so economics provides some of the why behind finance. Got it. Now let's dive into finance itself. You mentioned these three core pillars: personal, corporate, and public finance.
That's right. Those are the main buckets.
Let's start with the one that probably affects everyone listening most directly: personal finance.
Yeah, personal finance at its core is just about managing your own money or your household's money.
Okay.
The goal is to achieve financial well-being, whatever that means for you, and to reach your specific financial goals. It really covers everything from daily money management to, planning decades ahead.
Can you give us some concrete example? What activities fall under personal finance?
Sure. Think about budgeting, just knowing where your money actually goes each month.
A classic.
Definitely. Then there's insurance, life insurance, health insurance, car insurance, protecting yourself from big financial shocks, managing a mortgage if you own a home, saving for things.
Like a down payment.
Right.
Or retirement.
Exactly. Saving for short-term goals, long-term goals like retirement, planning for taxes so you're not caught off guard, estate planning, which is thinking about what happens down the line, and just the basics like using banks and maybe starting to invest. It's a huge range.
It really covers a lot of life decisions. So what are the key things someone needs to focus on to do personal finance well?
Well, effective management really boils down to a few key areas. First, you absolutely have to understand your current situation. What's coming in? What's going out? What are you saving?
Know your numbers.
Know your numbers. Second, protection. Having the right insurance is crucial to handle unexpected risks. Third, taxes, you need to be aware of your obligations.
Right.
Then actively saving and investing that money so it can potentially grow over time. And finally, planning for that long-term security, especially retirement.
And the end goal.
The end goal is always meeting your personal financial objectives. They could be anything from covering your immediate needs comfortably to achieving really big life goals, like buying a house or retiring early.
And it sounds like the basics really matter here. How much you earn, your spending habits, how much you actually manage to save.
Oh, absolutely fundamental. Your income, how you spend, your savings rate, the investments you choose, they all massively impact your financial health. And don't forget that safety net of insurance.
Right.
But underpinning all of it, really, is budgeting. It's the tool that helps you live within your means and make sure you're putting money aside systematically for those bigger goals.
Without a budget, it's hard to steer the ship.
Exactly. If you don't know where the money's going, it's almost impossible to direct it where you want it to go.
Makes total sense for individuals. Okay, let's shift gears then. Let's look at the business side. Corporate finance. What's that all about?
So corporate finance deals with how companies, corporations, manage their money and financial activities.
Okay.
This involves figuring out how to fund everything they do, operations, new projects, deciding on their capital structure, that's the mix of debt versus equity they use, managing their accounting, and deciding where to invest the company's capital for growth.
And for a company, what's the main aim? What are they trying to achieve with all this financial management?
Typically, a primary objective for most corporations is to maximize shareholder value.
Meaning make the company worth more for its owners.
Essentially, yes. It means making decisions that are expected to boost the company's long-term value for the people who own shares in it. This involves both big strategic moves and also careful day-to-day financial handling.
Can you give us some examples of what someone in corporate finance might actually be doing day to day?
Sure. They could be analyzing whether to invest in a big piece of new machinery or maybe expand the business into a new country. Those are capital investment decisions.
Good decisions.
Huge decisions. They also have to figure out the tax implications of pretty much everything the company does. They're constantly monitoring cash flow, making sure there's enough liquid cash on hand.
Keeping the lights on.
Basically, yes. They're responsible for preparing the financial statements, the balance sheet, income statement, that show how the company's doing. And they're involved in decisions like, should we pay out profits to shareholders as dividends? If so, how much?
Okay. And you mentioned earlier there were sort of three main areas within corporate finance.
Yes, broadly speaking. The first is capital budgeting. This is all about evaluating potential long-term investment projects like building that new factory or launching a new product and picking the ones that are likely to be most profitable.
So choosing where to place the big bets.
Exactly. For a smaller business, it might be deciding whether to buy new software or hire another person. The second area is capital financing.
Which is?
That's about how the company actually gets the money it needs to fund those investments and just run the business day to day.
Okay. Where does the money come from?
It can come from borrowing bank loans or issuing bonds, which are basically IOUs, or it can come from equity selling shares of stock in the company.
Debt versus equity.
Precisely. And it's a really critical balancing act. Take on too much debt, and the company could be very risky if times get tough. Issue too much equity, and the ownership stake of the existing shareholders gets diluted.
Right. That sounds like a tricky balance to strike. What's the third area?
The third is working capital management. This is more about the short-term finances.
Okay.
It involves managing the company's short-term assets, things like inventory sitting on the shelves, and accounts receivable, which is money owed to the company by its customers, and also managing its short-term liabilities like accounts payable, which is money the company owes to its suppliers. The goal is just to make sure the company has enough cash flowing to cover its everyday operating expenses and meet its short-term debts as they come due. Smooth operations.
Got it. So personal finance for individuals, corporate finance for businesses. Which brings us to the third pillar, public finance. What's the focus here?
Public finance looks at the financial activities of governments. That means federal or national governments, state or provincial governments, and local governments too.
Okay, so how governments handle their money.
Exactly. It's about how they raise revenue and then how they spend that money.
Where does government revenue typically come from? Is it just taxes?
Taxes are definitely the biggest piece of the pie. Income taxes, taxes on investment profits, sales taxes, specific taxes on things like gasoline or tobacco, those are excise taxes.
Right.
But governments also get money from fees for services like park entrance fees or driver's licenses fines, and they also borrow money.
How do governments borrow?
Usually by issuing government bonds or other types of securities. Essentially, they borrow from investors, promising to pay it back with interest.
Okay, so they raise all this money. What do they spend it on?
It goes towards funding public goods and services, things that generally benefit everyone. Think about infrastructure, roads, bridges, airports, national defense. Social programs like Social Security, welfare, unemployment benefits,
Healthcare, education.
absolutely, healthcare funding, education systems, and also managing the government's own debt, paying interest on the money they've borrowed.
What are the main things people in public finance are talking about?
Well, a huge part is the government budgeting process itself, how they plan spending and decide which priorities get funded. Then there's fiscal policy. That's how the government uses its spending power and taxation levels to try and influence the overall economy, maybe stimulate growth during a recession or cool things down if inflation is high.
Okay.
And, as I mentioned, managing government debt is a massive ongoing concern for most countries.
And the overall goals for public finance.
Generally, the aims are to allocate resources efficiently, to provide those public services people need, maybe try to achieve a fair distribution of income through taxes and spending, and promote overall economic stability. Keep the economy on an even keel.
We've definitely covered a lot of ground with these three pillars. I believe you put together a table summarizing the key differences.
Yes, I did. It's just a quick way to see them side by side. Personal finance. Focus is individuals' households. Activities like budgeting, investing. Goal is personal financial well-being. Corporate finance. Focus is businesses, activities like capital, budgeting, financing, working capital. Goal is maximizing shareholder value, ensuring the company thrives.
Got it.
In public finance, focus is government. Activities involve taxes and spending. Goals are efficient resource use, income distribution, economic stability. It just helps clarify the different scopes and objectives.
That's a really useful summary. Thanks. Now, earlier we talked a bit about finance and economics. Let's maybe revisit that and also look at how finance relates to other fields like accounting.
Right. So, as we said, finance and economics are super closely linked. You can almost think of finance as a specialized area within economics.
Yep.
Economics looks at the big picture, production, distribution, consumption of goods and services. Finance zooms in more specifically on money, banking, credit, investments, assets, liabilities, the whole financial system aspect.
And that old theory versus application distinction.
Yeah, as we discussed, that's really fading. What's more important now is this idea of financial economics, applying economic theories directly to understand financial markets, factoring in things like time, risk, opportunity cost, how information flows.
And you mentioned how that link is important for us individually, too.
Exactly. Because understanding those big economic forces, like inflation or interest rates, directly helps you make better personal financial decisions, especially around investing.
Makes sense. Now, what about accounting? Accountants deal with money, too. How does finance relate to accounting?
Ah, yes. Accounting is absolutely fundamental to finance. You can't really do finance without accounting.
How so?
Think of accounting as being mainly focused on recording what has already happened financially. Accountants track transactions, prepare the financial statements, the balance sheet, income statement, cash flow statement. They give you a clear picture of a company's financial performance up to a certain point in time. It's historical, mostly.
Okay, so accounting looks back.
Primarily, yes. Finance, on the other hand, takes that historical data from accounting and uses it to look forward.
Okay.
Finance professionals analyze past performance, sure, but then they use that to forecast future needs, plan future investments, make strategic decisions, all aimed at increasing the company's value going forward.
So accounting is like keeping score, and finance is planning the next play using that score.
That's a great analogy. Accounting provides the scorecard where the company has been, where it is now financially. Finance uses that scorecard to chart the future course, making decisions to improve the score in the future.
Okay.
They're completely complementary. You really can't make sound financial decisions without reliable accounting information.
That clarifies the relationship nicely. All right, let's zoom out again. Thinking about the big picture, what's the fundamental purpose of finance? Why does it even exist? And why should, someone listening right now care about it?
The most fundamental purpose of finance, really, is to help allocate capital money efficiently throughout the economy.
Allocate it efficiently. What does that mean in practice?
It means getting money from people who have it and aren't using it right now to people or businesses who need it and can put it to productive use. Finance makes this happen in several ways.
But like how?
Well, it makes borrowing and lending possible. If you need a loan for a car or a business needs funds to expand, finance provides the mechanisms. It gives people ways to invest their savings, hopefully earn a return.
Stocks, bonds, that sort of thing.
Exactly. It helps businesses raise the capital they need to start up or innovate. And it creates markets where these financial instruments, stocks, bonds, can be easily bought and sold.
So it's kind of like the plumbing system for money in the economy, making sure it flows where it needs to go.
That's another good way to think about it. Yes, it keeps the economic wheels turning. Think about it. You can buy a home because mortgage lending exists. That's finance.
Right.
A company can fund research for a new drug or build a new factory because it can borrow money or sell stock. That's finance too. Without these mechanisms, a lot of economic activity just wouldn't happen.
So it's pretty critical then.
Absolutely critical at every level. For you, the listener, understanding personal finance is vital for your own financial security and reaching your goals. For businesses, managing finance well is crucial just to survive, let alone grow and be profitable. And for the whole economy, a healthy, well-functioning financial system is essential for driving development, encouraging investment, and making sure markets work efficiently.
So it really is an engine.
It truly is a critical engine for both individual prosperity and the economy as a whole.
Okay, so finance is this big, important system. What are the actual pieces? What are the main components that make it all work?
Right, the financial system itself. You can think of it as the overall framework, the structure that allows all these financial activities to happen. It's basically a network of institutions and markets.
Institutions and markets.
Exactly. They work together to channel funds from savers people or entities with extra money to borrowers, those who need money.
Let's start with the institutions. Who are they?
Financial institutions are essentially the intermediaries, the go-betweens.
Like banks.
Banks are the classic example, yes. Commercial banks where you have your checking account, but also things like investment companies that manage mutual funds or insurance companies that help manage risk.
Boy, what do these institutions actually do?
They play several really crucial roles. They pool together savings from lots of individuals and businesses.
Right.
They then channel those funds towards productive investments, lending to businesses, for example. They help manage financial risks, often by offering tools for diversification. They provide the payment systems we all rely on. And importantly, they create credit, which, as we said, fuels a lot of economic activity.
Okay, so institutions are the intermediaries. What about financial markets?
Financial markets are the actual places, the platforms, where financial instruments get traded.
So where the buying and selling happens.
Exactly, where you can buy and sell stocks, which represent ownership in companies, or bonds, which are essentially loans to governments or corporations.
Are there different types of markets?
Oh, yes. You have the stock market, the bond market. There are also money markets for short-term debt, the foreign exchange or Forex market for trading currencies, commodities markets for things like oil or grain, and derivatives markets for contracts whose value depends on some other asset.
Wow, okay. Lots of different markets. What's their main purpose?
They serve several vital functions. They make it possible for companies and governments to raise the capital they need. They provide liquidity, meaning it's easy for investors to buy and sell assets quickly if they need to.
That seems important.
Very important. They offer tools for managing financial risk, especially through derivatives. And they give individuals and institutions a place to save their money and potentially grow their wealth over time.
So do the institutions like banks operate within these markets?
Absolutely. Financial institutions are often major players in the financial markets. They act as brokers, dealers, market makers, facilitating transactions between buyers and sellers.
So they're interconnected.
Very much so. This close relationship between institutions and markets is what helps ensure money flows efficiently through the economy and helps maintain overall financial stability. It's a whole ecosystem.
And I think you have one more table for us summarizing these components.
I do, yeah.
Oh, that.
Just breaks it down simply. Financial institutions. Examples like banks, insurance companies, their role. Connect savers, borrowers, manage risk, facilitate payments. Then financial markets. Examples like stock market, bond market, their role. Platform for trading, raising capital, price discovery, liquidity. Seeing them listed like that just highlight how they work together.
This has been incredibly insightful, a real deep dive into what finance is all about. We've covered a huge amount. Its links to economics, the three pillars, the connection to accounting, why it matters, and the system itself.
Absolutely. We've seen that finance is, well, it's dynamic. It's got many facets, but it's all centered around managing, creating, and studying money and financial systems.
Right.
We broke it down into personal, corporate, and public finance, those main branches, each tackling different challenges and aiming for different goals.
And I think one key takeaway is that understanding finance isn't just for finance professionals anymore, is it? It feels increasingly vital for everyone navigating, the modern world.
That's exactly right. Financial literacy, Just having a basic grasp is more critical today than maybe ever before.
Mm.
Our economies are complex, the financial decisions we all face are numerous,
Mm.
and it's not static field either. Finance is constantly changing, evolving. Think about technology's impact fintech, global interconnectedness, shifting economic conditions. It's always adapting, which underlines why it remains so significant.
So maybe a final thought for our listeners to chew on. Consider how understanding the way these three pillars, personal, corporate, and public finance, interact and influence each other, how that understanding can empower you, not just to make smarter decisions about your own money, but maybe also to better understand the broader economic and political world around you. What new questions does thinking about this framework raise for you personal about how wealth is created, how it's managed, how it's distributed in society?
That's a great point. It goes way beyond just your bank balance.
Exactly. It connects to the whole system. Thank you for joining us on this deep